The 500-plus drop in the stock market on Thursday caused some people to feel as if they should hit the panic button. But here to tell us why we shouldn't do that just yet is Emily Johnson of Polaris Capital Advisors, who hosts Money Matters here on WHHI. Emily, thanks so much for coming in.
Pleasure to be here.
Now, we're taping this on a Friday, shortly after 11 in the morning. The market at this point is down another 100-some points. First, let's look back to Thursday, though. What was the main reason for that big drop in the stock market?
Well, it's obviously been building, as the U.S. had their debt situation that was hopefully, at least there was a temporary solution that was found earlier this week, But yesterday was really driven by Europe. I'm sure everybody's heard the acronym PIGS, the PIGS countries. That's Portugal, Italy, Ireland, Greece, and Spain. So the PIGS countries are really what's driving what's going on in Europe right now, and really there's a lot of concern about the fiscal health of those economies. We heard about Greece quite a bit over the last month. We've seen the austerity measures that have had to have been taken in Greece, and now it's coming in Italy and in Spain and in Portugal, some of the much larger economies in Europe, and much larger than Greece, obviously, and that's raising a lot of concern. And part of the concern is because they now have a central currency in the EU, and before the EU was around, when each of those countries had their own individual currencies, their governments would be able to go out and pump cash into those economies the way that our Treasury did, the way that Ben Bernanke did when our economy hit the skids and we had quantitative easing and they started pumping a lot of cash into the economy. They can't do that as easily there because they have a central currency. So they're really getting boxed into a corner because you have all of these disparate concerns and they're trying to find one solution. So another thing that's happening with that is their interest rates are going up because of that concern. Every time the governments go out and they try to issue more bonds to fund whatever their needs are, their interest rates continue to go up, which of course just exacerbates the problem. So they're really getting boxed into a corner. And I think that is definitely what was on the forefront yesterday. Part of it, even though that's been coming down the pike, part of that was sort of pushed under the rug when we were looking at our debt concerns. Now there's a lot more visibility on theirs. And I think that's really what drove yesterday's decline, and still concerns this morning as well, even though we had positive jobs numbers that came out.
What about the depth of the drop, though? Is there any reason why it would be so steep?
Well, I think that there's a concern about the so-called contagion effect, that maybe it's not just Italy and Spain and Portugal. Now it could be Germany, it could be, so that whenever they say contagion, they're saying that this is going to spread throughout Europe. So there's a concern that it's going to be much bigger, number one. Number two is you now have, and this is something that we saw in '08, and I'm sure other people have heard about the whole fat finger that occurred a year or so ago. You now have these quant models and large money managers that basically what that is large money managers that manage money based on a computer formula. They usually have that computer formula based on some kind of technical indicators. They're looking at stock charts of the S&P, and they'll have sells and buys that are triggered by certain movements in the market. So it might be perhaps the market goes down 3%, there's a sell trigger in there. So some of that was definitely what was happening later in the day. You usually see that sort of we call it the witching hour, between 3 and 4 in the afternoon is usually when you'll see some of those go off. And sometimes it can be the opposite direction. It might be that model is saying buy, because there was, say, a 3% drop or a 5% drop. But definitely the markets are looking a lot more at technicals right now. And so that's certainly something that we're watching. And as we see further declines this morning, that's certainly something that we're looking at is the S&P hitting that magical number that we might actually need to trigger a sell. We're certainly watching that.
But your decision doesn't come from a particular computer model, or does it?
Oh, no, absolutely not. I mean, we look at lots of different factors. We look at technical indicators. Certainly, we look at charts of the S&P. We look at charts of the Dow and the NASDAQ and, the various indices. But we also, are looking at individual holdings as well. We look at interest rates. We're looking at research and various reports all the time. Part of the problem with what's going on market-wise, it's the same thing that happened in '08, is it's not just the panic, it's the perception of panic. And
how do you avoid that, though, Emily? I mean, it's frightening to see 500-plus points down. And how do we get people not to go into panic mode?
Well, one, I think that we just constantly have to be in contact. and ask the questions that you want to ask. Take a look at your portfolio and ask the questions of your advisor. How am I positioned? Am I positioned correctly? Should this happen? Should this happen? What is my broad allocation of my portfolio? And within each of those, how are each of those being managed? Ask some of those questions, number one. But also I think it's worth pointing out that there is a lot of positive going on as well. Over the last several weeks, we had earnings reports coming out in July, earnings of the second quarter. Those were very positive. Approximately 75% or so of the companies that actually reported positive or above expected earnings. That's fantastic. So the market really is moving in the right direction. The difficulty is that now those managers that reported those strong results are now seeing a lot less visibility on what the economy is going to be going forward. The worst thing that can happen to the stock market is a lack of visibility. That's a negative. The positive, though, is that the companies have stronger balance sheets now than they did in 2008. While 2008 was a disaster for most of us, for companies that have now survived that, they have leaner companies, so they're able to be more nimble and move with the economy. Two, they also have much better and healthier balance sheets. So as the companies start getting more visibility, I really do think that people are going to start looking at the fundamentals again and realize that now is a great time to be looking at strong companies and possibly even be putting more money to work in those strong companies, because they will rebound when we start looking at their actual fundamentals.
Well, Emily Johnson, I'm going to let you end there on a positive note for us. I want to thank you so much for coming in this Friday morning to talk about the stock market. Thanks so much.
Thank you very much.
And when we come back, we will speak with Town Manager Steve Riley of Hilton Head Island. Don't go away.